Hello everyone. Hello George.
Good morning,
Good morning.
Anka.
Yeah, good morning. Look, I wanted to ask you, what are your thoughts on what has happened to the Silicon Valley Bank?
Yeah, very interesting situation, because that obviously sparked quite a few different reactions. SVB, Silicon Valley Bank, is a different sort of bank than the normal banks that you would see. Silicon Valley Bank predominantly lends money to the, or deals with the tech sector in the Silicon Valley. Now the tech sector has been awash with money. So the normal situation with banks is that they lend money to their account holders and make a profit. In their situation, no one wanted money. They put money into the bank as deposits because all the venture capitalists were very much involved with the tech companies, the rising, the new formation companies, the new establishing companies. So actually, Silicon Valley Bank ended up with a lot of money, which they thought, well, we don't want to risk it, we'll just put it into low-risk government bonds, which is what they did. There was one thing they didn't do, which was a mistake, which was most banks take out insurance to cover bond losses. Silicon Valley Bank didn't do that. And as a result of the interest rates rising, these low-risk bonds basically started to lose money because the interest rate was less than the actual standard interest rate. As well as the bank rate is as the bank rate, that's right. As well as at the same time, this obviously happened over a period of 12 months. We've had COVID, venture capitalists have been a little bit or less active, and so some of those companies wanted to start withdrawing their money. And obviously, Silicon Valley Bank got to a situation where they couldn't support the withdrawals, and therefore, they were closed. And that's really what happened. It was their own fault for not taking out insurance to cover bond losses, and that's all that's happened. So
basically, if they would buy an insurance policy to cover the bond losses, nothing will happen.
But they wouldn't be in this situation.
And do you know what's the cost for that insurance?
No, I don't. I'm sure we could find that out, but I would imagine it would be substantial.
Yeah, but it's still less than losing.
But it's less than losing, the amount that they did because you're talking hundreds of millions here. You're not talking small amounts of money.
So how does this situation fit with what happened to the Credit Suisse?
Well, that's interesting. Actually, that situation has nothing to do with Credit Suisse. The Credit Suisse situation has been going on probably as a bank for 2 or 3 years, where they've made bad investments. They probably weren't too affected by COVID. It's more that they made some bad investments, some bad calls. The other major thing with Credit Suisse is their main account holder is actually the Saudi National Bank. So, and recently with changes from the regulator, the Saudi bank actually had to withdraw quite a lot of the money. And in fact, 10 days ago, they withdrew just over 110 million from Credit Suisse.
For this Credit Suisse is not such a big amount, 100,000.
It's to do with liquidity, and again to do with, which is why you've heard the recent news that Credit Suisse or in fact UBS, who have taken over Credit Suisse, have actually cancelled all their tier 1 type bonds that they're doing, which is very new for banks to do. So Credit Suisse effectively there was a run on Credit Suisse. First of all, when the news came out, the regulator stepped in and said we will support Credit Suisse. Yeah. But then over the weekend just past, there was a run on Credit Suisse where people, as I say, the Saudi National Bank plus others withdrew money from them, and therefore the regulator couldn't sustain or didn't want to sustain
So
that.
what actually caused it? The withdrawal of the Saudi, or actually the rumors that things not going well, and where then the rumors came from?
So it wasn't just rumours. In the last 12 months, the Credit Suisse stock price has gone down by 72%. So it's been a history of bad...
There's no smoke without fire.
No, there's no smoke without fire. Bad investments, bad choices, and then latterly a run on the bank, and which is why UBS stepped in. Now, in actual fact, UBS stepping in has sort of quietened the noise about the bank sector. This was never a comparison to what happened in 2008. But it caused a lot of nervousness. Certain countries, particularly European countries, like the UK, Germany, Switzerland, France, are very big on their banking sector. So this really did affect those countries. Other countries where the banking sector isn't as big in terms of bringing income, bringing taxes to those countries, it has less effect.
But then you said, talking about countries, how did it actually affect markets in general?
Yeah, so in actual fact, core stocks, the typical core stocks like you say Procter & Gamble, Berkshire Hathaway, Apple, stocks like that have actually yesterday had a good day. So generally, it's not affecting the markets too much. There was lots of nervousness. Markets went soft for 2 or 3 days, but the news that UBS have taken over Credit Suisse has certainly solidified the markets.
So, but actually, the UBS taking Credit Suisse. Are they taking all the responsibilities, or what are they taking?
Well, Credit Suisse, before the deal came through, wiped out what they call these tier 1 bonds. So they're going to default on them. They're not going to pay them. So don't forget that the Credit Suisse liabilities was predominantly caused by people taking the money out. A lot of those people now will actually put the money back in because UBS have taken over. But it was on the back of 12 months, and probably longer than that, 2 years of bad performance from Credit Suisse. So that's happened. The other interesting effect is not just what's happened on the markets, but we're just about to have a rate increase. I think what will happen. The US was going to increase rates, rumoured by 0.5%. I think the US will probably only increase it by 0.25%. That meeting is this week. Also, the UK were going to increase rates. We're sort of talking about increasing rates. I don't think the UK will increase rates. I think generally, the UK, Europe will remain as it is and relook at the situation. We already know that inflation has reduced, is slowing down. It's the right thing. And also because of the war and the commodity prices, the cost of living is very high. So increasing rates is very destructive at the moment.
Yeah. Okay. So basically, these two banks the two crises with the two separate banks had nothing to do with each other. However, they just happened in quite a short while.
It just caused a bubble of nervousness. And insecurity.
We're not facing another bank crisis.
We are not facing another bank crisis.
So it means everything is all right then.
Well, hopefully we can move forward. There are still lots of things going on, which mean the market probably will remain fairly soft. The war in Ukraine is affecting. And it does. It has a restraint on what's happening in the markets. The big enemy, inflation, is being combated, but that's still a long-term journey.
It's time to pay for a cheap money, right?
That's right, exactly.
Okay.
Thank you.
Yeah, thank you. Thanks.